Hi Professor Hall. This is my quick video overview of my Netgear analysis. So to start, Netgear was founded in 1996 and it is a developer, designer, and manufacturer of computer networking equipment and computer hardware. So they operate in three specific business units, including a retail, commercial, and service provider unit, and they sell through multiple channels like traditional retailers, online retailers, wholesale distributors, and direct market resellers. So before I start with my analysis, I want to give a quick overview of what I'm doing today. I'm going to begin with an analysis of Netgear's current financial situation, and then go into the assumptions I needed to make in order to complete this valuation. Next, I provide an overview of the company's optimal capital structure and their current dividend policy, and then I finish up with some information about their initial public offering and their stock performance over time. So in order to accurately analyze Netgear's capital structure and dividend policy, it is first important to understand their current financial situation. And for the sake of my valuation, I calibrated most of my assumptions to fit with Netgear's current share price of $32.50. At this current share price, and with an average of 34.7 million shares outstanding in 2014, the company has a market capitalization of around $1.13 billion. So currently, Netgear has no short or long-term debt. It is also really important to note that Netgear has seen high volatility in their income statement during the last 2 years. Specifically, in 2013, they saw a high charge in both litigation reserves and restructuring charges. Litigation reserves were due to a high-profile lawsuit against one of their major competitors, D-Link, where they were accused of infringing on several patents, which caused Netgear to need a high reserve of litigation. They also had high restructuring fees because of a $3.3 million fee for separation charges associated with the consolidation of several of their teams in order to help drive efficiencies and align resources. So finally, the huge drop in 2014 was due to a $74 million goodwill impairment charge. And this was a result of a decline in the estimated fair value of the service provider business unit as a result of a decline in long-term revenue and profitability projections. So for the sake of my analysis, I consider these charges to be one-time occurrences in order to smooth out my projections and eliminate any inconsistencies. So although Netgear's revenue growth has slowed in recent years, I project their growth to remain at a stable 7% through the next 10 years. There are a couple reasons why I'm optimistic about Netgear's growth. First, they recently acquired one of their competitors, AirCard, in the mobile broadband devices industry, and I believe that they can leverage AirCard's products to drive revenue growth in their retail segment. I also believe that Netgear's continued investment in emerging markets will help fuel growth. Most of their past growth has stemmed from emerging markets such as the Middle East, Africa, and Asia Pacific, and I believe if they continue to invest in these markets, they can fuel growth. So after initial projections, my estimated long-term growth rate for Netgear is 2.8%, and this is a result of a long-term reinvestment rate of 27.8%, and an expected return on reinvested capital of 10%. So these values seem like they're on the low end, but I believe that they're accurate because of consistent competition that I believe will happen in the next years, and which will make growth difficult for the company. So with an estimated risk-free rate of 2.5%, a market risk premium of 5.75%, and an equity beta of 1.11, we get a cost of equity of 8.8% and a cost of debt of 3.25%. And this yields a weighted average cost of capital of 8.8%, considering Netgear has no debt. So there are several important things to take into consideration for my optimal capital structure. The first being that Netgear's value continues to increase as it takes on debt. However, it is likely that Netgear will not increase its debt-to-value ratio more than that of the industry average, which yields a BBB credit rating. It's also clear from my valuation that as soon as the credit rating drops, the firm value drops, but it continues to increase as the firm takes on debt and gets more tax breaks. This can be seen further in my paper and my valuation where I provide a graph. So overall, I believe that Netgear should issue enough debt to remain at a BBB credit rating, and I believe that this will put Netgear in a similar position to some of its main competitors and still maintain a solid investment grade credit rating. Any further debt would drop the rating to a BB, and investors might become wary. So this debt will raise the debt to book value ratio to 43.4%, and it will increase the value of the firm from $1.12 billion to $1.19 billion. And at this new capital structure, Netgear will have approximately $967 million worth of equity and $75 million worth of debt. And the total value per share will increase from $32 to around $34. So in order to ensure that Netgear maximizes shareholder value, they need to choose the optimal ratio of dividends and share repurchases. So currently they do not pay out a dividend, and they do participate in share repurchase programs. For example, in 2008, the board of directors authorized the purchase of up to 6 million shares, and in 2014, the board authorized the purchase of up to 3 million shares. So we can see that in 2014, the company repurchased approximately 738,000 shares. So in order to maximize their value, I believe that they should continue with this no dividend policy and continue to participate in share repurchase programs. I want them to supply 100% of surplus cash back into the business and ensure that investors receive capital gains. And under this proposed plan, Netgear would spend $492 million to repurchase 9.36 million shares, and this would decrease the shares on issue from 34.7 million to 25.2 million. So finally, I want to cover some information about Netgear's initial public offering and their stock price performance. So they initially intended to go public in 2000, but they postponed the offering due to market conditions. And this is interesting because it proves the point that historical IPO returns are distorted because of timing. So the company officially went public in April of 2003, and it offered 7 million shares of common stock at an initial price of $14, and it was able to raise $98 million worth of capital. So first day results for the IPO were very strong. It ended the day at $17.69, which represents a 26% return for the day. And we can also see a little bit more about the return by looking at 3-year return and total return throughout the life of the stock. So over 3 years, the company yielded returns of 10.23%. Compared to market returns of 33%. And this falls in line with the trend that IPOs underperform the market over 3 years. However, it is important to note that this industry saw a lot of volatility in those 3 years. Some of the large competitors underperformed the market, similar to Netgear. Some performed at the market, and some exceeded the market. So finally, the total returns of Netgear over the life of the company have been 82.25% compared to the overall market return of 108%. It is also important to note here that Netgear has outperformed many of its competitors, with most falling under 50% return over the lifetime of Netgear stock. Finally, it is important to note that For the industry, Netgear would have been a wise retail investment, but overall, an investor would have been better off just buying the market.